welcome to NDTV Profit. You're watching Market IQ. My name is Rucha Somaya and we'll quickly begin looking at the markets. But before that, our big headline for today is the decision from the RBI's monetary policy. Here are the 5 key takeaways from RBI Governor Shaktikanta Das's speech. Number 1 takeaway is no rate cuts. The RBI governor said that the MPC has voted 4:2 to keep the rates unchanged. Takeaway number 2, the RBI has also decided to keep a neutral stance in order to watch inflation amid and also ensure growth. Takeaway 3 is that the RBI has lowered GDP growth projection to 6.6% from 7.2% earlier. And takeaway number 4 is that the inflation is projected to be higher at 4.8% from the expectation of 4.5% earlier. Well, the governor said that the last mile of deflationary period has quote long and arduous unquote. And the takeaway 5 is that the CRR, that is cash reserve ratio, has been cut to 4% from 4.5%, and this will inject more liquidity of over 1 lakh crore rupees into the banking system. Well, the cash reserve ratio is the amount of money that needs to be set aside by the bank to be able to pay out deposits. Well, the markets reacted almost instantaneously to the RBI governor's speech. There was a sharp dip when the governor announced that the rates were unchanged. Some minutes later, when he announced that the CRR, that is cash reserve ratio, will be cut, the markets took heart and surged again. Take a look at how this played out.
The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is to reduce the CRR of all banks to 4% of demand and time liabilities, that is NDTL, and this will be done in 2 tranches, 2 equal tranches of 25 basis points each.
Banker Rajiv Anand said that he expects a rate cut of 50 basis points in the next cycle. Well, this is due to what he calls a palpable slowdown in the economy. Listening to what he had to say.
The problem that we've seen so far is, on the one side, we have certainly, like I mentioned to you, the slowdown in the economy is palpable. But on the other side, we are certainly seeing inflation being quite sticky at this point in time. We need to see those inflation numbers, come down into the 4 handle before we can even think about a rate cut. So I think the RBI's own expectations is that we will see a inflation number in the vicinity of about 4% sometime in February. So the earliest expectation that we have as far as the rate cut is post-Feb. But having said all that, I think the rate cut cycle itself is going to be quite shallow at the very best in this sort of an environment. We don't expect the rate cycle to be more than 50 basis points, which means that the 6.5 could at best go to 6%.
Well, my colleague Vishwanath Nair is at the RBI headquarters and he breaks down what the RBI's decision means to you and me. Over to you, Vishy.
So you just heard the RBI governor talk about the latest monetary policy announcement. Here's 5 key takeaways that we at NDTV Profit are bringing to you. The first one is that there is no rate cut. So as far as interest rates are concerned, it is a status quo policy. Repo rate continues to be at 6.5%. What does that mean? Well, essentially your or my interest rates on loans as well as deposits are not really moving anywhere. The other part, the second takeaway, is that the RBI and the MPC have maintained a stance at neutral. Now remember that till before the last policy, the stance was at withdrawal of accommodation, which means that all the accommodations that the RBI and the MPC had made during the COVID era, those were being withdrawn. So now what the MPC is saying is that we are in a neutral stance. Essentially, we are not committed to any kind of rate cut nor rate hike. Depending on the evolving situations, we will take the next call. The third important takeaway is that the RBI has lowered its own GDP forecast. So GDP forecast earlier was 7.2%. That has been lowered to 6.6%. This comes on the backdrop of a weaker than expected Q2 GDP number. And there is hope that at some point in time in the second half of the financial year, the government will boost some amount of consumption, some amount of spending. It will also, there is also going to be some amount of agricultural produce, which is going to again boost the rural economy. So growth will come up, but maybe not as much as what was originally anticipated. The fourth key takeaway is on CPI inflation. There, the MPC and the RBI have decided to up their projection from 4.5% for the full financial year to 4.8%. What does that mean? Well, essentially, the RBI is saying that in Q3, that is the October-December quarter, you will likely see food prices keep trending higher, and therefore you will see overall inflation trending higher. But eventually, as the Kharif crop comes in, these prices will start to tinker down, but that still has a bearing on the overall number for the financial year. That's why from 4.5 to 4.8%. The last key takeaway and probably the most important news of the day is a cash reserve ratio being cut. Now, what the RBI is saying is that we will be cutting the cash reserve ratio by 50 basis points in two tranches, so 25 basis points each over the course of December. This will boost the liquidity in the ecosystem by about 1.16 lakh crore. What does this mean? Well, essentially, banks will have more money and they will have less of a funding crunch, which means that credit availability for you improves. Hopefully that translates into some amount of interest rate benefits, but that part may not actually happen. What will probably happen is that banks are slightly more comfortable and your access to credit remains as easy as possible.
Well, thanks for that, Vishy. But to talk to us more and to give us some more insights on the RBI meet policy takeaway, we are being joined by Kaushik Das, who is the Chief Economist of India and South Africa at Deutsche Bank. Well, thanks for joining us, Mr. Das. And in addition to him, we also have Mr. Dhiraj, the Economist and Strategist at ANZ Research. Well, thanks, gentlemen, for joining me. And with me is my colleague Pallavi, who tracks the economy very closely. My first question to you, Mr. Dhiraj, well, this one to you. What do you make of this outcome which has come this morning?
Well, look, I was in the rate cut camp for today. The idea was that the growth slowdown, which is underway, is sharper than expected initially. So, of course, there is a requirement for policy support, and that is the stance I maintain even now. So, I do think that while the CRR cut was quite welcome from a liquidity perspective, the rate cut is possibly getting delayed to February, but not later. And I do think that the growth outlook is still optimistic as far as the Reserve Bank of India is concerned, and growth will likely undershoot even the revised assessment. And I think that warrants policy support. So yeah, 25 pip rate cut in February, three rate cuts in total. But as of today, welcoming the CRR cut, I was hoping that a rate cut also happens, but better late than never.
All right, thanks for that, Dhiraj. But coming to you, Kaushik, thank you so much once again for taking time out to speak to us. But any quick thoughts, any quick summarization of today's events, broadly in line with your expectations, right?
Yeah, hi Pallavi. It came just in line with our expectations. Even before the GDP data came out, our view was that the CRR should be cut. And the reason being that, you were seeing some tightness in liquidity in the system because RBI was intervening in the FX market. And, we knew that, in the next few weeks, we'll have advanced tax outflow, currency circulation leakage. My calculation is about 1.6 trillion INR will flow between December to March. So there'll be tightness in liquidity. And we think that RBI will continue to intervene in the FX market. So in order to take care of domestic liquidity and be consistent with the neutral stance, first what you needed was to cut the CRR so that domestic liquidity doesn't tighten too much. You've done the change of stance to neutral in October. The next logical sequencing should be to cut the CRR and make the liquidity a little bit more comfortable. And then you follow it up with a repo rate cut in February or April, depending on the data. But this is the sequencing that we expected, and RBI, delivered on that today. And we are not surprised at all. I mean, it came in line with our expectations. I think Governor Das talked about timing, being the key of any decision. And I think the CRR cut has come at the right time. Going forward, I think you will get a repo rate cut. Typically, in the past, 20-year period, different cycles, the maximum that RBI has held on between the end of a rate hike cycle and start of a rate cutting cycle is 11 months. So this has almost become, 2 years. And part of the reason is because the Fed delayed its own rate cutting cycle. So to that extent, I think beyond this, it could have a little bit of problem on growth going forward. RBI will be forward looking when it comes in February, and at that time it will look at inflation being at close to 4%, and even growth, if you get 6.5%, it is still below potential, and therefore RBI will have justification to cut the repo rate in February, in my view.
Okay, so, taking that forward, Kaushik, so, you've spoken about how growth might still be below potential. Now, I do want to understand, what are you making of economic activity currently? Is the worst behind us? Even the governor alluded to, bottoming out of high-frequency indicators in Q2. Broadly, we're all expecting a better second half to the fiscal. So, in terms of growth as well as inflation, would it be fair to say the worst is sort of behind us?
Yeah, so the broad view is that the 5.4% number that we got, that is probably, the lowest that we've got. Going forward, it will be better than that. And there could be some upside revisions to that number as well. We know that GDP number tends to be very volatile, and the revisions, often are pretty meaningful when it happens. So remember that October-December GDP number comes out in end February, and it will come with all kinds of revisions to the past numbers. So all these numbers can change. Now, the issue is that RBI has given a 6.6% forecast for the year, which would require, second half growth to be about 7%. I would not say it's impossible. It is possible because we are seeing, kind of economic indicators taking a little bit of upward move from what we've seen in September. October was much better than November, but overall, I think we can still get to 6.5%. Maybe 6.6 is a little bit too much. But the number that RBI has given for FY26, 6.9 and 7.3% in the first half, I think those are slightly on the upside. Those could have downside risk. The broad story is that if you still manage to grow at 6.5, 6.7%, that is below potential growth rate of the economy. And, different people have different estimates for potential growth, but most people believe that potential growth rate for India is 7% or slightly higher. So from that perspective, if you have growth coming below potential as an average for the year, and you have inflation coming towards 4% in the next 3 to 6 months, monetary policy should always be preemptive and forward-looking. So when you come to February and you take a call for the next 3 quarters, I think that will be a good enough time for the MPC to decide to cut the repo rate. Already 2 people have moved for a rate cut from 1:5 earlier. I think in the next policy you will have a rate cut from the MPC.
I have a doubt there, Kaushik. So you've spoken about how we're still looking at below potential growth, right? But another camp is also of the view, right, that so far we were seeing some benefits from post-pandemic recovery, and now we're looking at growth normalizing. So, how do you sort of view that as, and what is potential growth rate in the current scenario then looking like? Are we still looking at potential growth rate of 7-odd%, or do you think that figure is now slightly lower?
No, so when we came out of the pandemic, we thought that the potential growth rate has fallen, and that's why we thought RBI's neutral real rate should be lower at about 1%. RBI themselves came out with a calculation of 1%. Then what we realized is that the potential growth rate has not fallen that much because of the supply side reforms and a lot of changes that have happened in the economy. So probably potential is still 7% or higher. And that is probably one of the reasons why the core inflation trajectory was coming down when RBI hiked rates, tightened liquidity, came out with macroprudential norms. If indeed the growth was more than the potential growth rate, then core inflation should have gone up. So to that extent, we think the potential growth rate is still 7% or higher, and that hasn't kind of got affected that much. Compared to that, if you take care of all the noises and the idiosyncrasies that are there in the GDP data, deflator, I think we are growing below potential. And the point that you made, what happened was after COVID, a lot of growth support came from the urban side, and the rich people in the urban areas supporting growth. Now those people who have made luxury purchases of a property or a car, they're not supposed to do it every year. So those 2 year period of spending that had happened, I think that has kind of slowed down. So that incremental slowdown is reflecting on consumption growth. Rural consumption is improving on the margin, but that cannot offset completely the slowdown in the urban consumption. Therefore, overall, you are seeing growth coming down to 6.5% odd number, and that is lower than the potential. And the problem is that next year you have the global backdrop, probably, which could become more challenging. Exports could become an issue if tariffs are imposed. So taking all that into consideration, our growth estimate for next year is also 6.5% FY26 compared to RBI's at 7%. And that's why we think some monetary support is required, particularly when the government will keep on consolidating the fiscal deficit towards 4.5% next year.
All right, Dhiraj, coming to you, like Kaushik just mentioned about, the fact that we might require some monetary support. You've also spoken about possible requirements for some policy support for growth as well. Do you think there's requirement for some fiscal policy support, especially given what we've seen consumption trends to play out as now, even when we are seeing signs of some sort of a rural recovery, now it's urban consumption that's, growing at a slower pace. On what basis can we even expect that to then flip?
Look, at the moment, I don't think there is a very strict imperative for fiscal to push for urban consumption. It's a cyclical slowdown. Let's sort of understand that first. And business cycles happen always. So I don't think there is a strong fiscal imperative to push urban consumption higher. In fact, I would still think that the imperative for the fiscal should be to lower the fiscal deficit further. So I would advocate for the government to stick to the fiscal deficit reduction path, even in FY26. Having said that, I see the support for monetary policy as being more important at the moment, because whether it's business capex or the real estate cycle or urban consumption, these are all to some extent interest rate sensitive sectors which may have felt the burden from higher real rates as well as macroprudential tightening of the recent quarters or in the recent past by the Reserve Bank of India. And as it appears in high frequency indicator that the real estate cycle or the construction cycle looks to be peaking, urban consumption has moderated substantially, and wage growth does not seem to be very encouraging for the outlook on private consumption growth. So I think at the moment, monetary policy is where we need greater adjustments than the fiscal policy. But at the same time, I would also acknowledge that, coming off a very strong base and a period of very strong years, strong growth years, this is perhaps reflective of a cyclical correction, which is usually inevitable.
All right, guys, this is Vishwanath Nair joining in. Kaushik, I want to ask you, so I hope you've not answered this already, but the one point that the regulator, the RBI governor mentioned very clearly was the fact that they feel that they have been right in line with the curve. They've not been behind the curve at all, and that they do not want to take any knee-jerk reactions just by reading one growth number. Having said that, do you agree that maybe the RBI has been with the curve or maybe behind it? What's your assessment looking like?
So I think, today's decision of cutting the CRR and not cutting the repo rate immediately, I think that's a very, very prudent and timely decision. Because if you had cut the repo rate immediately, it would have also signaled that you are panicking, that growth has kind of fallen completely, and you are kind of going to stay in that trajectory for a long time. When you're saying that your growth will improve over the next few quarters, this was maybe a temporary kind of number, and not this kind of low numbers are expected. I'm not saying growth hasn't slowed down. We have been arguing for a long time that growth is slowing down. But nobody expected growth to be this low. But this looks like more of an aberration. Going forward, maybe we'll not hit the RBI's numbers, but growth will still be quite decent compared to global standards and compared to India's own growth as well. But the point is that today, what they needed to do was first take care of the liquidity, because unless you have sufficient liquidity in the system, even if you cut rates, you would not have effective transmission of those rate cuts into the real economy. And this also gives time for RBI to kind of be sure with their assessment whether inflation will actually come down to the extent that they're hoping. Our guess is it will come down, but I think RBI wants a little bit of confirmation from the data that the worst is behind for inflation as well. What we saw in October at 6.2, November we're expecting around 5.6, and then incrementally it comes down towards 4% in the first half of next year. Similarly on growth, if they think that growth is kind of improving, but maybe not to the extent that they had hoped earlier, then taking both these things into consideration, they can consider cutting rates in February. And monetary policy, as I keep on saying, is always forward looking. It's not about just the growth rate that we are getting now. It is about taking a call that 2 quarters or 3 quarters down the line, or maybe even a year down the line, what would be the growth number, what would be the inflation number without any monetary policy support. And if you believe that those numbers could be much lower without monetary policy support, then you need to start easing 3 quarters before, and not wait till the time growth has fallen quite low and you are behind the curve. So I think RBI is on ball, and February would be a good time for RBI to cut the repo rate once they have already cut the CRR in December.
Right. Right, Dhiraj, I want to take this question with you. The FCNRB announcement that came from the RBI. Now, during the press conference, reporters did ask that, does this take the pressure away from the forex reserve spending that they've been doing, the depletion that has been happening? The RBI governor and the deputy governor sort of played it off as a lot of it is because of valuation losses and not necessarily only because of rupee intervention. I just want to get your view, how effective a tool is FCNRB as far as managing the forex situation is concerned?
Look, if the situation was really dire and we needed a lot of that foreign capital to come in, maybe that would have been an effective tool at the margin, giving that required boost to the reserves. Right now, the situation is not such. I mean, reserves have fallen, of course. They're sharply lower the past few weeks, but they're not at a level which makes you very nervous. But I do acknowledge the fact that the drawdown in the reserves, whether it's because of valuation effects or actual intervention, coupled with the fact that the RBI's forward book is looking so stretched on the net short side, tells me that the pressure on the rupee has been substantial. And it's understandably so. Not only our external headwinds were against the currency, so to speak, but after a very long time, after several years, even the domestic pull factors, are not working in your favor. Growth has slowed, inflation has remained sticky, current account is widening, even if it's manageable, equity markets are taking a bit of a beating. So I do think that when both your push and pull factors are not working in your favor, the pressure on the currency can be sharp, and possibly the only way for USD INR is higher from here, maybe even in quicker adjustments that we have seen in the recent quarters. So coming back to the question on FCNRB, in such a situation, it may marginally help, but I don't think it would be a strong tailwind that can really offset the kind of depreciation pressure that we have seen in the rupee in the recent weeks.
Right. Thank you so much, gentlemen, Kaushik and Dhiraj, for those insights. And I thank my colleagues Vishwanath and Pallavi as well for joining this conversation. But that's all that we have on the show for now, viewers. It's from me, Pallavi, Vishwanath, and the team who has put this show together. Thank you very much. Do stay tuned to NDTV Profit. Lots more action on the other side.